All right, so our next guest, also one of our favorites, hosted a conference call yesterday and came away with seeing some fresh challenges with these folks, maybe even some contradictions. I'm going to bring in Bianco, research president Jim Bianco. And Jim, so last year, wealth managers made the biggest shifts in their portfolios, 39% on the second to the right-hand column there, to fixed income bonds. And they're going to put a lot in this year, 35%. Now, it was supposed to be low-hanging fruit, but it hasn't really worked out that way. They're down a lot this year. They're down a lot from a year ago when the smartest money on Wall Street started making this move. You think they'll stay the course? Are bonds still the answer?
I think that over the long term, they could stay the course, because what's different about bonds now than 2 years ago is there's a yield. There's a yield on broad-based bonds of approaching 5%, where 2 years ago, when the bond market sold off, there was no yield. And so over time, every day you own a bond portfolio, you accrue more money, you accrue interest in that portfolio. And look, over a long period of time, with a big yield like this in the bond market, you can still get 5, or if you want to take money market funds, 5.3%. Now, what's the stock market supposed to return us? Long-term estimates are around 8% a year. I know it seems like it's 8% a month now, but it's supposed to be about 8% a year. Well, if the bond market's giving you 5 or close to 5, you're getting well over half that gain. So the bond market is somewhat competitive with the stock market. It may not be competitive with NVIDIA, but for the rest of the stock market, it definitely is.
Although it is tough, though, when the bond market doesn't necessarily live up, doesn't deliver what conservatively you think it will deliver, and the stock market has one of these crazy outsized years. And a lot of people are pointing to evidence that maybe we could be in for a series of these big years, new highs begetting new highs. But I do want to ask you before that about this no landing, because you've been in the no landing camps at some point. I think at one time there were more people on the moon than there were in the no landing camp. You're getting more folks in there. On this call, were there more people considering a no landing possibility?
Oh, yeah, I think that there definitely is, because the data, no landing, of course, means that the economy just keeps flying, at 35,000 feet. It doesn't start to descend or anything else. And the data has been very, receptive of that. You've been seeing strong payroll numbers. You've been seeing hotter than expected inflation numbers, and that will continue. Now, the downside to the no landing camp is mortgage rates are going to stay up, interest borrowing costs are going to stay up, and that those are going to become, the yin and the yang of this, So, yeah, the economy's doing great and everything's doing good, but don't then turn around and expect then that interest rates are going to fall and that it's going to get cheaper to borrow money.
Hey, before I let you go, Charles Schwab has a new survey out. Only 9% are worried about a market correction. 52%, these are the active traders, 52% plan to add to individual stocks. Is that a yellow, maybe a red flag for you? Is there too much optimism now at this stock market?
Oh, there's definitely too much optimism. And, two things could be true at once. You could be walking into a stiff correction that, could really shake your confidence. But then that might be a stiff correction doesn't mean it's the end of the secular bull market. But, yeah, definitely the amount of complacency in the market has got to give somebody some pause. Only in the extent that if we do in the next several months walk into another 10% correction, and the last one we had was October, it was only 4 months ago, that, you might want to rethink, but you should almost expect something like that is probably coming before the end of the year, given how giddy everybody is.
Yeah, absolutely. All right, Jim, next time we'll get you your own introductory music as well. Have a great weekend, my friend. All right, folks, the Fed might be